Today's lesson is from Chapter 14, Problem 1B. Bear with me as I pull up your other screen. Okay, for problem 14, 1B, we're still going to be a corporation in this chapter. And what we're going to be looking at in this particular problem is we're going to be looking at how we can raise money for our corporation. And we're going to look at three plans in this particular problem. And we are wanting to raise $80 million for our corporation. And under each one of these plans, the income tax rate is going to be estimated at 40% of your income. Notice they've given you information for each one of the plans. In Plan 1, we are planning to sell 9% bonds. Excuse me, that's not for Plan 1. That would be for Plan 3. Our preferred stock, we're going to be issuing that in Plan 2. And we're going to also be selling some bonds in Plan 3. Our common stock is going to be issued in Plan 1. That's the only thing that we are going to be doing to raise the $80,000 in Plan 1. So what we want to do is look at each one of these plans to see how it will affect net income and how it will affect something that we call earnings per share on our common stock. Before we get into earnings per share on our common stock, I really feel like I need to at least talk to you about the corporate form of an income statement. You'll remember in the last chapter, we looked at a statement of retained earnings and we looked at the stockholders' equity section of the balance sheet, but we really did not discuss the income statement. So I want to show you what an income statement looks like because I felt like the textbook didn't do a very good job of showing you what an income statement would look like. So hold on just a minute. I'm going to stop sharing this screen and I'm going to pull up my Excel spreadsheet, and hopefully that'll give us a little bit of clarification on how to prepare an income statement. All right, if you bear with me until I get my screen adjusted like I want to look at it. Okay, the given information from Cengage, I've restated that in the top part of this spreadsheet. The income statement for a corporation would consist of the revenue account, and usually the revenue account is going to be sales. I have shown you the sales account, which is a revenue account, and I've just put X marks in for the amount because in this problem, they really want you to focus on the bottom portion of the income statement, not the top portion that you should remember how to do from ACC 120. But I want to show this top part of the income statement to you again as a review for the income statement. And then I'll add to this income statement what you can expect for a corporation. This is a corporation form of an income statement. We would start with our sales, which is our revenue account. And then you would subtract from that the cost of your goods sold. you'll remember that that was the largest expense that you had for a company, and that your sales revenue would be your major form of revenue for this company. That's why we list these first. Once you know what your sales are and your cost of goods sold is, you will subtract the cost of goods sold from the sales, and that will give you a gross profit for your company. The gross profit is the profit that you have available to cover your operating expenses. Operating expenses would be listed next. Now, operating expenses, as you might remember from Accounting 120, can consist of selling expenses and administrative expenses. In this case, what I've done, instead of separating them out, I've just put them all together, all of our operating expenses together. And these items on line 7 and 18 are just showing that there are many other operating expenses, but I just wanted to show you the basics of how this income statement is put together. So our operating expenses would consist of things like advertising expense, depreciation expense, amortization expense, depletion expense. Some of these accounts you learned about in a previous chapter in this course. So I wanted to put those in there so you'll see where they belong. And then there would be many other operating expenses that I did not list. Eventually, you'll find the total of your operating expenses. And when you subtract the total of your operating expenses from your gross profit, that will leave you with is something that we call income from operations. Now, this title could also be called income before bond interest and income taxes. That's what they express to you in the instructions of this problem. But I wanted you to see that in the income from operations, there's actually some other revenue and expenses that a company could possibly have. An example of other revenue would be interest revenue. Interest revenue would result from you allowing, you making an investment in another company and earning some interest off of that. We'll be talking a lot about interest revenue in the next chapter, but I wanted to go ahead and show you that interest revenue could come under the category other revenues and expenses. This category, other revenue and expenses, sometimes I've seen this stated as other revenues, gains, and other expenses and losses. I just tried to make this income statement short and brief to the point, but I wanted it to be enough of the income statement to give you enough information to be able to solve your first homework assignment. But interest revenue would go under other revenue and expenses. Interest expense is also another type of account that would go in other revenue and expenses. And the reason we put interest expense here is because this is a financing activity and really doesn't have anything to do with our normal operating expenses. So both of these really come from your financing operations of the company, at least these two that I've got listed here in front of you. Interest expense will come into play in this chapter when we discuss bonds. And so we're going to talk about bonds in a little bit in this particular problem. And the interest that goes off of the bond will be calculated and put in the income statement under other revenues and expenses. What that will leave you with is a title that we call income before income tax. So we would take the amount of the income from operations, we would subtract out any interest expense if we had any for bonds, and that would leave us with income before income taxes. In a corporation, you may remember from last chapter that corporations have to pay federal income taxes and they have to pay state income taxes. And it's based on the amount of net income that they have available to pay those taxes. In this problem, they give you an income tax rate of 40%. That's going to be your income tax. So what you're going to need to understand is that in the real world, the corporation would fill out a tax return just like you fill out your personal tax return to the federal government. This tax return is where we would determine the amount of the income tax expense for that period of time. And income tax expense would be an expense that is deducted on the income statement. It comes sort of toward the bottom of the income statement here in order to help us to determine the net income. So you might remember from Accounting 120 that we went to this income before income tax. We called it net income then because we were doing a sole proprietorship form of business in ACC 120, not a corporate form of business. So in a sole proprietorship form of business, you wouldn't have any income tax that the sole proprietorship pays. The income tax would go on the personal return of the partners or the owners of that particular business. So because this is a corporation, we have to add a line to our income statement, and we're going to call that income before income tax. The income tax expense is determined by multiplying the tax rate times the income before income tax, and that will give you the expense. But in the real world, this amount here would come from your tax return that you fill out. The difference between your income tax expense and your income before income tax will give you the net income. In this problem, they also want you to calculate something that we call earnings per share, which would be found at the bottom of your income statement for a corporation. And usually they just state the amount of the earnings per share. But before we can put the earnings per share on our income statement, we would need to know how to calculate it. So in this problem, we're going to discuss how to calculate earnings per share, because that's really what they want you to do in requirement number 1. You might notice on this spreadsheet that I've got 3 separate income statements, one for each plan that we are doing in this particular problem. So we're going to start with plan number 1. And in plan number 1, the given information just means that we are planning to issue stock in the total par value amount of $80 million. This is the way that we're going to raise money for our corporation. Because we're just issuing stock to raise money for the corporation, there would be no bond interest because there are no bonds in plan 1. There's no preferred stock that we've issued in plan 1. We've just issued common stock. And you might remember from last chapter that when we issue common stock, our cash would be increased by $80,000. We would sell the stock for the total par value. And on our balance sheet, we would find the common stock account listed at the total par value. Well, something that's important in determining earnings per share is you need to also be able to determine how many shares of stock that we have issued and outstanding. You might remember on your balance sheet that we prepared in the last chapter that on the balance sheet we would list common stock, we would list the par value, we would also list the shares authorized, which they did not give you in this problem, and we would have listed the shares that we have issued, which they didn't give you in this problem either. So you're going to have to figure out a way to determine what the shares issued were in Plan 1. And to do that, we will divide $20 par value into the $80 million, and that will give us the number of shares of common stock that we are planning to issue. Now, in the given information for this problem, for requirement number 1, they're telling you that the income before income taxes and bond interest is $10 million. Because we're not issuing any bonds at all, we don't have any bond interest to calculate. So that means that the income before income tax is going to be $10 million. We have to apply the tax rate to our income before income tax. And what we're going to do here is we're going to take the 10 million that came from C24, we're going to multiply it by the 40% tax rate, and that will give us income tax expense for this company. The income tax expense is deducted from the income before tax to get the net income amount of $6 million. In Cengage, they want you to record the earnings per share. Before we can calculate the earnings per share, we need to know certain things. We need to know what our net income is. Our net income comes from line 26, is $6 million. We need to know if there are any preferred dividends, because when we calculate earnings per share, we want to reduce the net income by the amount of dividends that we're giving to our preferred stockholders, so we'll get the true net income that's only available to common stockholders. Notice our earnings per share is calculated based on common stock, not preferred stock. So because in this plan there was no preferred stock that was issued, we don't have any preferred dividends, and so the 0 here is because there were no preferred dividends in plan number 1. We would subtract the dividends from the net income to leave us with what is available to our common stockholders. The net income available to the common stockholders then is going to be divided by the common shares outstanding. In this case, the common shares outstanding is 4 million shares. Let me show you how we calculated that. So if I scroll on down, I've calculated the common shares outstanding by the information that is at the bottom of the page. The total par value of the common stock was given in this transaction. The total par value of the common stock was 80 million. So on line 39, that's where I get the total par value of the common stock. It was given, and the par value per share of common stock was also given in Plan 1. Do you see there that it's $20 is the par value per share for the common stock? In order to find the common shares of stock outstanding, you would need to divide the $20 par value per share into the total par value, and that will tell you that you have 4 million shares that are available for this particular company in Plan 1. Once we know what the common shares are, we're going to divide this common shares into the 6 million, and it will give us earnings per share of $1.50. What that is exactly what this is stating. This is the amount of earnings per share of common stockholders, or earnings per share of common stock, that the stockholders would earn. They earn $1.50 per share of stock. This information would be important to stockholders in letting them know how well their investment has done in this particular time period. So $1.50 is the amount that you would put into the earnings per share in Cengage. So I'm going to stop sharing this Excel screen with you, and I'm going to go back to Cengage, and we're going to enter the information into Cengage. So right here in plan number 1, they want you to put $1.50. That's the earnings per share on the common stock. In the next part of this, they want you to do the same thing, find the earnings per share on common stock for plan number 2. In plan number 2, we're disregarding plan number 1. We're going to plan number 2 now. This time, we have decided that we could possibly raise $80 million by selling $40 million in preferred stock. This is preferred stock that has a 5% dividend rate associated with it. And the par value of this stock is $25. So this is plan number 2, that they thought that if they sold some preferred stock, they could come up with $40 million to go toward the $80 million that they want to finance. The common stock for plan 2 that they are planning to sell is $40 million this time. Again, there are no bonds that we are planning on issuing during this time period. We're just planning on selling our preferred stock and our common stock in plan number 2. And we want to see how that would affect our earnings per share on the common stock. So again, I'm going to stop sharing. I'm going to go back to our Excel spreadsheet. And I'm going to share this with you. We're looking at income statement number 2. We're still using 10 million as our income before interest and before income taxes. So our income from operations is actually going to be $10 million. So that's after we've calculated all this, we've come up with $10 million. That was a given amount in requirement number 1. Because there were no bonds in requirement number 2, or in plan number 2, I should say, we didn't issue any bonds at all. There's going to be no interest expense that we're aware of in this problem. So the income before income taxes is going to be, once again, 10 million. If we had issued some bonds and we had bond interest, it would go right here and be deducted from the income from operations, because expenses will decrease our revenue. But in this case, we didn't have any, so our income before income tax is still $10 million. We would take the 10 million, multiply it by the 40% income tax rate, and that will give you $6 million. So the net income is $6 million. This time, because when we're determining the earnings per share, it's only on common stock. If we have any dividends, we need to deduct them from the net income. And because in this plan, we have issued 40 million of preferred stock, the dividends that we owe to the preferred stockholders will be 5% of this $40 million. So 5% of $40 million is how we come up with the preferred dividends. So 5% of 40 million is $2 million in dividends. This would need to be deducted from the net income in order to determine the net income that's available to our common stockholders. Once we know the net income that's available to common stockholders, then we want to go back and determine what our common shares outstanding are. Notice in this plan, it went to 40 million. So we're going to take 40 million and divide it by $20 to get the total amount of common stock in Plan 2, which is 2 million shares. This 2 million shares would be divided into the net income that was available to the common stockholders, and that will give us our earnings per share of $2 for Plan 2. So that $2 is what you want to put into the Cengage problem. So again, I'm going to stop sharing. I'm going to go back to my Cengage problem and share that with you again. And for plan number 2, we're going to put in $2. Now we're ready to go to plan 3. So again, I'm going to stop sharing this with you. I'm going to go back to my Excel spreadsheet. I'm going to share this screen with you, and we're going to look at the third plan, which is this part right here. And let me scroll over for just a bit there. So you can see what I'm talking about. In Plan 3, we have issued bonds at 9%. Now, what bonds are, they are documents or they are instruments that we can issue or we can sell to people to raise money for a corporation, but they're really like liabilities to us. We have to pay the people, the bondholders that we've sold the bonds to. We have to pay the money back that we borrowed from them. So bondholders are like creditors of our corporation, and bonds are like liabilities to us. And these bonds will carry interest rates where we have to pay interest back to our bondholders. In return, the bondholders will give our corporation the money to use for a certain period of time. Usually bonds have a stated amount of time with them, such as 20 years or 10 years. Bonds are long-term liabilities, so they're going to have a period of time that's longer than 1 year associated with them. But they can come in time periods of 5 years, 10 years, 20 years. And I think in most of the problems, they issue bonds in this chapter for like 10 or 20 years. In this particular problem, they didn't tell us what the life of the bond was, but they did tell us it was a 9% bond. And so what that 9% means is that this bond, these bonds that you are planning to issue, you're going to have to pay interest at 9% off of the total amount that you have borrowed from your bondholders. And that borrowed amount in Plan 3 is $40 million. So we're planning to borrow $43 million from our $40 million from our bondholders, and we're agreeing to pay them 9% interest. That $40 million is going to go toward the total $80 million that we're planning to raise as money or capital for this company, so that we can maybe finance an asset that we might want to buy with that money. We're trying to raise $80 million for our operations. So $40 million of that is going to come from issuing bonds. The $20 million of that is going to come from issuing preferred stock, and another $20 million is going to come from issuing common stock. So we're selling our stock, and we're also selling bonds to raise a total of $80 million for this company. And we want to see how that affects the income statement. So I'm going to go over here to Plan number 3 that we've got here. And you'll notice in Plan number 3 that the income from operations is still the given amount of $10 million from requirement 1. That income from operations is really the income before bond interest has been calculated and before taxes have been taken out. So we start with 10 million. Notice this time in this income statement, we've had to calculate interest expense. And the reason for that is because we are planning to issue $40 million in bonds. Those $40 million in bonds are going to cost us 9%. So we're going to multiply 40 million times 9%, and that will give us 3,600,000. That's the interest we're going to have to pay on those bonds that we have issued for $40 million. Because this is an expense, it's going to be deducted from our income from operations, and that's going to leave us with income before income tax, this plan, at $6,400,000. Again, that's the difference between the interest expense that was calculated because we are issuing bonds in plan number 3 of $40 million at the interest rate of 9%. That's how they got the $3,600,000, and that $3,600,000 is deducted from the income from operations to get your interest expense. Excuse me, to get your income before income taxes. So subtract interest expense from the income from operations, and that will give you $6,400,000. This $6,400,000 is going to be multiplied by 40% to get the income tax expense of $2,560,000. We will deduct our income tax expense from the income before income taxes, and that will give you net income of $3,840,000. To calculate your earnings per share, it only goes toward common stockholders. So we will take the net income that we found from Plan 3, and we'll have to calculate the dividends for our preferred stock. So you'll notice that we have issued $20 million in preferred stock. If you multiply $20 million times 5%, that will tell you the amount of dividends that we're going to pay to our preferred stockholders. These dividends would be deducted from your net income to give you the net income that was only available to the common stockholders. Our net income that's available to our common stockholders is going to be divided by the common shares outstanding. Notice this time, the common stock that we're planning to sell is 20 million in total par value. We will divide this total par value by the par value per share of $20, and that will give us 1 million shares of common stock that we are using to determine our earnings per share. We're going to divide this 1 million shares of common stock that is outstanding into the net income that's available to the common stockholders, and that will give us an earnings per share of $2.84. So I'm going to stop sharing my screen with you. I'm going to go back to Cengage, and I'm going to put in the amount. And if I recall correctly, it was $1.84. It's the amount that's on the spreadsheet. Okay, I didn't recall correctly. So it must be more than $1.84. So if you'll follow with me, we'll stop sharing. I'm going to go back to Excel. It was $2.84. So that's what I should have put in. All right. So it's $2.84. And that's your earnings per share for plan number 3. In requirement number 2, they want you to determine for each of the plans, the same plans that we were using before, but this time we're going to assume that the income before bond interest and income tax is $6 million. So we're really doing this the very same way, except we're not starting with 10 million. This time we're going to start with $6 million. And so I've got a Excel spreadsheet that I can show to you for that. So I'm going to stop sharing this. And we're going to go to the Excel spreadsheet. And I'm going to share that with you. And I'm going to go to the second part, which was requirement number 2. This time we're on requirement number 2 for determining the earnings per share with the net income amount of $6 million this time. So for plan number 1, we didn't issue bonds, we didn't issue any preferred stock, it was just common stock. The income from operations this time will be $6 million. There's no bond interest to worry about, so the income before income tax is $6 million. 6 million times 40% is how we come up with the income tax expense. The difference between the income tax expense and the income before tax will give you your net income that's available to the common shareholders. The net income is $3,600,000. There were no preferred dividends because we are choosing not to issue preferred stock in this case. The net income that would be available to the common stockholders is still going to be $3,600,000. We're going to divide the common shares by the common shares outstanding. That was your total par value divided by the par value per share. It's the same way that we did it in the previous problem or the previous requirement number 1. We get 4 million as the number of our shares. So if we divide 4 million common stock shares into the net income that's available to common stockholders of $3,600,000, that will leave us with 90 cents as our earnings per share. So that 90 cents I'm going to put into Cengage. And this was requirement 2. So we're really doing it the very same way that we did before. The only difference is we're starting with income before income taxes and bond interest at $6 million. Plan number 2, we're going to issue some preferred stock this time and some common stock, but no bonds to get us $80 million. Let me jump to the correct one. Correct. Okay. Okay, we're on the right spreadsheet. All right. So 6 million is our income before income taxes and also before any bond interest. There were no bonds that we issued. So the income before income tax is going to be the same. We're going to multiply that by 40%. That gives us our income tax expense. The income tax expense would be deducted from the income before income taxes, and that will leave us with $3,600,000. The net income is $3,600,000, but in plan 2, we had some preferred stock that we issued. So we have to determine the preferred dividends. In plan number 2, the preferred stock was 40 million we would multiply that by 5%, and that will give us the dividends of $2 million. We'll subtract $2 million from the net income, and what we have available to common stockholders is $1,600,000. That $1,600,000 is going to be divided by the common shares outstanding, and in plan number 2, we get that by taking 40 million divided by $20 par value. That will give us 2 million shares. 2 million shares divided into the net income will give us earnings per share of 80 cents. So 80 cents goes here. Now we're ready to look at plan 3. In plan 3, we did issue some bonds. We issued bonds at 40 million at 9% was the interest on them. So our income from operations is 6 million from requirement number 2. We got to determine our interest expense. Our interest expense is 40 million times 9%, which will give you 3,600,000 as bond interest. That bond interest is deducted from our income from operations to give us income before income tax of 2,400,000. This would be multiplied by 40%, which will leave you with income tax expense of 960,000. We would subtract the 960,000 from the 2,400,000, and that will leave us with net income that's available to everyone at $1,440,000. Our net income is $1,440,000. We got to subtract out what we are paying to our preferred stockholders. Our preferred stockholders, remember, we are issuing 20 million. We're going to multiply that by the dividend rate of 5%. That's going to give us $1 million in dividends. The difference between the net income and the dividends that we paid to preferred stockholders will leave us with the net income that's available to common stockholders at $440,000. This $440,000 would be divided by the common shares outstanding. To get the common shares outstanding, we take the 20 million and divide it by $20 par value. So 1 million shares is divided into the net income that's available to the common stockholders, and that gives us earnings per share of 44 cents. So for plan number 3, the earnings per share is 44 cents. In the last part of this problem, they're wanting us to fill in some of the blanks. The principal of plan 3, the principal advantage of plan number 3 is that there would be an investment that would need to be made by common stockholders at less money. And so what they're saying to you there is, if we issue bonds in plan 3, then we only have to issue stock at 20 million. Notice these other plans have the stock issued at larger amounts. What can happen to a corporation is, if you'll remember from last chapter, your common stock has voting rights, and voting rights means that they have the ability to manage the corporation. So in plan number 3, we've kind of eliminated that ability for the stockholders to manage our company. But in return for that, we have to pay interest on these bonds. So there's a trade-off here. And the interest expense on the bonds that we would have to pay, but we would have less voting rights for our common stockholders. So that's also something that they might want to take into consideration. If we use plan number 1, all of these people will have voting rights toward the company, so they're more likely to be able to manage the company a little bit better. They have rights to vote in procedures for the company. That's what common stock is about. And for our preferred stock, the reason that we issue preferred stock and keep the stockholders happy is that they're guaranteed a 5% dividend rate. No matter what dividends are declared, they're going to get 5% of the earnings that would be distributed to them. So that's all I want to talk to you today about this particular problem. So thank you for watching, and we'll see you soon. Bye-bye.